Well, I have probably one of the best business channels currently in the world on business, finance, and economics education. I have recorded now more than 500 lectures, more than 20 different courses. My channel alone is better than Yale Open Course University within the finance of business, finance, and economics. And I've been recording now over 10 years. I started in 2007 and 2008. One of the first courses that I recorded in 2008 in April, February, March, April, before the global financial crisis was about the coming global financial crisis. Why would it come? What was the mechanism of the crisis and all the other stuff? And similarly, just 3 months ago, before I came here, 3 months ago, that would be end of March, I also had a very nice lecture that is actually recorded on video and posted on the internet, called Worse Than 2008, explaining why the current situation is significantly, meaning in the year of 2018 is significantly worse than what it was in 2008, and why the coming crisis, when it is coming, will be significantly worse than the last one 10 years ago. And I go through about an hour and 10-15 minutes to explain that. Now, how many of you were actually here last time? It's like I see 2 people, 4 that were here last time, 3 months ago. And how many of you were yesterday? Okay, 2, 3, 4, 5 or more. Okay, so we got actually a lot of people here that are relatively new. So yes, he was explaining about my extensive academic background, but it is extremely unfortunate that in my academic background I learned nothing about gold. Most of what I learned about money and banking was fundamentally wrong. I was teaching in 2007 at the American University in Bulgaria, money and banking. And during the course, well, I had to, the one and only textbook that pretty much every student in the world uses by Frederick Mishkin, which is just called Money and Banking. And I started teaching from it. And this was the textbook that I studied in 1991 as a business student. Back home in Bulgaria, we all use American textbooks as we do now. And as I've been using the textbook, oh, there's a mistake here, that's not wrong. Oh, there's a mistake here, that's wrong. Oh, there's a mistake here. And quickly I'm discovering 30 or 40 different straightforward errors, mistakes, or manipulations. And I'm spending quarter of my time explaining in classroom, well, this is what the textbook says, this is why and this is wrong, and this is what's the correct one. And then students get to complain, well, why are we using this textbook? And the answer is, well, you need to use it because this is what everybody else in the world studies. This is what everybody else in the world knows and understands. So now you need to know what they know, and then you'd better know why they're wrong about all those things. Unfortunately, that's how far we are. The situation is exactly the same with macroeconomics. Most of macroeconomics and business cycles is fundamentally wrong. That's very sad. Now, when it comes to finance and investments, there is not a single word about gold. It's like commodities don't even exist. Okay? In other words, half of finance is stripped out of commodities. They don't talk a lot about currencies. In other words, the economics and finance education is very, very weak, highly deficient in certain topics, and very misleading or dead wrong in other topics. If you don't get your own education, you are gonna be food for Wall Street, okay? And Wall Street is a good one. Now, how many of you believe in investing stocks for the long run? How many? Stocks for the long run. Okay. Well, let's try. Okay, there's one more over there. If you invested in 1990, 28 years ago in Japan, what will be your about 28-year-old long return? I have the answer. Back then, the Nikkei was exactly 40,000. Today, it crashed another 1,000 points down to 20,000. This means if you truly invested for the long run, from 40,000 investment, you'd be now at 20,000. So you'd lose 50% in 28 years, and that does not count depreciation against the dollar, and it doesn't count inflation and loss of purchasing power. In other words, you'd invest for the long run and you'd lose about 3/4 of your money. Okay, well, what about investing in real estate? Does it hold value? Well, try investing in Rome in the year of 500 or so, before the barbarians, ran over Italy. Well, how long it took the property to recover its value? Roughly about, since the rise of Venice and the independent states, and let's say 700-800 years. So for 500 years, you're sitting on a long-term losses, okay? Well, what about real estate? Again, the best example is, of course, Japan. You bought a property in 1980, whatever, 88. 30 years later, properties are down in nominal value, roughly about half. Again, you've lost half your money sitting on it 30 years. Now, in those 30 years, you could have made a lot more money in stocks, gold, and anything else except So, stocks, you can make an extraordinary returns and profits if you're investing at the right time, at the right place. And they have part of an investor's portfolio. Real estate can be an extraordinary way to make profits and money. Again, if you invest only like Donald Trump, when it's dirt cheap, when it's fallen, and you wait it out to rise. When you buy close to the peak, you may be 10, 20 years flat, okay? During the Great Depression, stock market crashed 10 times. In other words, it lost 90% of its value. Real estate did better. It lost 85% of its value. It fell 7 times. Right? If you're investing in the long run during the Great Depression, yes, you'll get your money back after 25 years without the inflation. Okay? So whatever was the Dow Jones, 25 years it would be exactly the same. And you gained and earned nothing on it. Okay? Exactly the same with real estate. Now there's a general, extraordinarily important, probably the most important lesson in investing, and I've been juggling between stocks and real estate, but it applies perfectly well for gold and bonds or any investment, is the following. You can make reasonably good or great returns only if you invest when the asset is relatively cheap and undervalued, and you're sure to lose money or not make for a long time if you buy in a highly overvalued asset. So it boils down not to the long term. It boils down to buying an asset only when it is relatively cheap. And if it's cheap, it would eventually prove a very good investment. And if it's overvalued, again, it could be real estate, it could be stocks or gold, you will not likely make money and you will most likely lose. It's all about valuation. Okay, and that's what back in the old days the books were starting about. And that's what I will be talking about. Let's see if I can keep pushing these buttons. Which way I'm pointing? Where's the...
It'll sense it.
Okay, well, so this is gold, is investment analysis. It is a lot more extensive for the simple reason that there are 5 fundamental ways to make investment analysis. Most of those are not taught in universities. That's another major deficiency. When you take a course in finance or any book, they'll just give you fundamental analysis. And they say, technical analysis, no, they ignore it. There's no such thing as technical analysis. There's no such thing as behavioral analysis. And they certainly claim that cycles don't matter. But of course, they do matter, okay? And of course, there's portfolio analysis, but they don't explain it the way it's done. And it's all down to fundamental analysis, which of course is very important anyway. So I'll be going through these 5 for the next whatever hour or so in detail. And I'll try to pause at the end of each of these for some questions on that particular one and to see what's happening. All right, so cyclical analysis. Investments are, in general, all investments, stocks, bonds, real estate, commodities, currencies, they all run in cycles. Cycles could be short-term, mid-term, long-term, and the longest one called secular. And secular will be always a bull market on the way up and bear market on the way down. And sometimes the bear market will be slightly longer and sometimes it will be slightly shorter, but it's more or less somewhat even in length. And secular markets can go from as short as 16 years, the case from 906 to 23, and they can run, 21 and more years. Some may have heard about so-called Kondratiev cycles. For the great Russian economist Nikolai Kondratiev, who identified the cycle, both the up and down side to be an average of 52 years. On the shorter end, he found it to be 40 years, roughly 20 plus 20. On the longer end, he found them 60 years, roughly 30 years up and 30 years down. Okay, so you can take an average cycle would be about 25 years. As I said, could be as short as 16, but it could go as much as 30. There's nothing wrong with that, okay, depending on other circumstances. So this is how the long term, the word secular in finance and investments means longest term, nothing to do with religion or secularity. All right, so I got 2 charts to show. Here is the first one, will give you a flavor. The best possible way to think about gold in terms of valuation is always to compare it up against stocks. And you compare it, one of the best ways, which we've had for way over 100 years, to compare it up against Dow Jones, because it's a very well established market. These are the top 30 US stocks. Again, historically we can do it up against London stocks, and the results are pretty much identical. And you have what's called a Dow Gold ratio. Dow stands for Dow Jones, is an indicator of a very good, like 95% correlation with the stock market. And gold is a proxy for commodities, or of course gold itself. And you can see the ratio going up and then down. Ratio going up means stock market going up. If it's low ratio, well, low ratio, you can look it out there, it's like 2 or 3 ratio, okay? You want to invest in stocks. Stocks are relatively cheap and gold is very expensive. And then you can see stocks can go up to, the ratio can go up to 20. In other words, stocks on the way up can easily outperform gold 10 times. In other words, you invest in both, stocks go up 10 times when you buy the stocks at the right time. Then, this is the Great Depression, 1929, stocks crashed. Remember, 95%, about 10 times. Stocks crashed 10 times, but at the same time, gold almost doubled. So gold outperformed 15, almost 20 times stocks, and you see eventually gold did a lot better than 15 times. Of course, in 32 or 3, you invested in stocks again. Stocks did remarkably better. They outperformed about 15, almost 20 times. They did better, okay? So, if you invested in stocks, you would have done phenomenally well. And if you had invested in gold, certainly not. Again, this is the same idea. You gotta invest at the right time in the right asset. And of course, 1966 marked the peak of the stock market bubble, and in general the stock market. And if you had invested for the long term in 1966, you would have waited 20 years just to get your money back in your return. In other words, to get back to, in other words, stock market was down, 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 moving up and down, but it took 20 years just to get your money back. But if you invested in gold in 1966 or whatever, you would have made on your money roughly 20 times. 20 times. In other words, gold was $30-some, let's say 35, and it went up to $850. So it could make a good 20 times, not 20%, 20 times. You put in 1 million, you'll end up with 20 million. Again, the one phenomenal performance, the other very poor. Again, same thing, 1980. You invest in gold in 1980, the price is 800 and something, and 20 years later, gold is 200. You lost 75% on gold. But at stocks, you would have made very well. You would have made on your money about 10 times. Dow Jones went from 1,000 to as much as 10,000 or so. Again, now you see the peak in 2000, that's the dot-com telecom bubble. Then you have the crash. Here, that's 2012. That's the European financial crisis. This is where, at the same time, stocks were crashing, and gold was going up, up, and up, because there was a global financial crisis, and separately, European and Greek crisis, okay? So, for that period, you would have done infinitely better if you had invested in gold, and not so well if you had invested in stocks. And we're right now somewhere in the ratio of 15, 17. It's actually very easy to see what the ratio is. Dow Jones today is 25,000, okay? And gold is 1,300 and whatever, 50. So the ratio is what, 16, 17 or so. So at 17, we can say very clearly that stocks are clearly significantly overvalued relative to gold, which is exactly the same as saying that gold is significantly undervalued relative to stocks. We're not saying yet anything about bonds or real estate, but about these two, we can make a very good conclusion. Now, you will see the next picture is significantly better, and it shows exactly the same idea. It's got the labels. This is the better picture because it starts from 1800 and it goes all the way to 2000 and whatever, like 10 or 15. So we got a 200 years of history, and it's the same thing. Here you can see what's the situation. When you're on the low end, stocks are low and gold is high. In other words, stocks are cheap, gold is expensive. Over there, stocks are expensive and gold is cheap. So here, stocks are a great investment, okay? Over there, stocks are a bad investment and gold is a good investment. Here, Stocks are low, gold is high. Again, stocks are low, gold is high. Now, you can see some cycles can be very, very long. From the 70s, they can go up to 30, 40 years on the way up. And then you see here in 1929, that's the portion over there. Stocks are high, gold is low. Then you can see quick correction. The correction could last for 4 or 5 years, okay? But it could last for 20 years, okay, as you can see. Now here, the upside is very long in time, from 1929 till 1966. That's good 35 years on the way up. And then the crash is from 66 to 1980 on the way down. It is about, what, 16, 15 years. Again, from 1980 to 1999, on the way up is 19 years, okay? Well, first leg a little bit down. This is where, after the European financial crisis was somewhat partially resolved. Gold for the last 4 years, from 12 to 16, was somewhat going down, okay? And the ratio, you see, is up into the 17s or so. Ratio is usually considered to be gold to be very expensive when the ratio is like 1 to 1 or 2 to 1, okay? And when the ratio is, let's say, 8 to 1, 10 to 1, 20 to 1, then the stocks are extremely expensive. Let's see if I have anything else for cyclical. So this is kind of like a summary of understanding the long-term cycles. Yes, please.
Can I ask a question?
Yes.
What does the green line represent?
The green line represents that there is some sort of a channel and that there is somewhat longer-term trend in those ratios overall. But this we're talking about here, 100 years. So this is where things seem to be somewhat within normal acceptable range.
Okay.
As soon as you move above the green line, you're seriously overvalued on the one end, and when you move on the other end, you're seriously overvalued for the other.
But if the green line is, you can say, the long-term trend,
yes,
can you not interpret that as today that stock is at the low end and gold is at the high end?
No, because usually when the correction, when there is a crisis, when the correction runs, historically it always overshoots to the ratio of 2 to 1 or 1 to 1.
Okay.
In other words, when these valuations move, historically on a gold standard, they move in narrow ranges.
Yeah.
Once we abandon the gold standard, they swing wildly, and they overshoot on both sides.
Okay.
They overshoot on the upside with the stocks, with stock market bubbles in 29, in 66, and in 99, and they overshoot in commodity and gold bubbles in the opposite direction. Okay, the overshooting is like markets go crazy and everyone's in 1979, everyone's buying gold, and they say, stocks are dead. Okay. So let's see more questions, please. Yes.
Yes, you have 1913 as a historical mark, being the creation of the Fed.
Yes,
when you created fiat capital.
Yes.
You said overshooting and undershooting on gold. The period before 1913 was gold related. When the Fed was established on a distant island near San Francisco or wherever, you see overshooting and undershooting on gold.
Yes.
Is that a kind of a point that gold has been a more volatile commodity? Onwards or
no.
Sorry, I just need to repeat the questions for recording purposes. So if I understand your question correctly, does the transition from the gold standard era to the fiat capital era, did that entail that gold became more volatile as an investment instrument?
Certainly not. It is the exact opposite. Paper money has become more volatile since the adoption of the Federal Reserve. Stock market has become remarkably more volatile, gyrating on the way up significantly more, and gyrating or crashing on the way down. In other words, since the Fed was established in 1913, and you had the paper managed dollar, gold has been just as stable as it has been for hundreds or thousands of years, but it's the stock market that went a lot wilder, and that's actually very easy to show. Yes?
But isn't gold on the graph, those with the very much variations on your graph?
No, this, again, it's important to understand how you see gold. You see, the one way to see gold, this is
my
gold.
question is on your graph. You have before 1930, you have a little deviation up and
Right.
down on
Correct.
the red line.
Correct.
When you come to after 30, then you have a lot of peaks up and you have a lot of peaks down.
Please, please,
Is
please.
that gold you are showing?
No. This is not gold. I'm not showing gold at all. I'm showing the gold-Dow ratio.
Ah,
And when it swings widely, it's not because gold was swinging widely. It's because the stock market was swinging widely. In other words, because the volatility was in the stock market. And therefore the ratio was more volatile, going to higher extremes because of the stock market.
Yes.
In other words,
I
stock
just
market
need to
goes
suck.
20 times higher on the way up, and then the stock market will go down 20 times or 15 times on the way down.
Sorry, Professor, just to summarize that exchange. So the line that is, the jagged line represents the gold to stock market ratio. It is not a representation of the volatility of the gold price. Is that correct?
Correct.
Right.
It is the representation of the stock to gold volatility. Okay? So stock markets, again, as we said, they can easily go 10 or 15 times up, and then they can easily crash 15 times down. Okay? For example, when gold goes down, it goes down 2 or 3 times. The stock market can go down 5, 10 times. Okay? All right, let's see what else we have.
One question here. One question here.
Yes, please.
So if I understand you correct, the one you showed before, it's only it's only stock market you showed. The udvikling i stockmarkedet.
Yeah.
Der er ikke noget at gøre med udviklingen i prisen på guld, vel?
No, so the question is, the graph you're showing here, this does not represent this only represents the development of the stock market. Is this is separated from the development of gold?
Again, it is the ratio between these two.
Yes.
It's not represent the
Yeah,
stock
I
market,
understand.
does not represent the gold market, represents the ratio between the two.
I understand that. Thank you.
Okay, yes, please.
But again, the green line
Yes,
compared to the, you can say, more the trumpet or what you will call it.
yes.
I don't still, I understand.
There is
don't understand. You have two, as I see, you have two trends here. You have an upward trend, making stocks in the very long
Correct.
trend
You see,
more expensive compared to gold.
absolutely
Yeah.
true. On
Okay.
the upside, yes.
But then you have the red lines here after the First World War.
Right.
Then you say that the lower end of the tunnel, or what you will call it.
Yes, of the tunnel.
Yeah,
Yes.
Is
Or
still
funnel.
funnel. Yes. Why isn't that some I don't understand the connection between the green lines and the two red lines.
Well,
exactly.
look, you see, it's very easy. Ratio goes from 20 down to 2. In other words,
Yes.
the ratio changes only 10 times.
Yes.
Now, the next time, people get a whole lot crazy in the stock market.
Yes.
The stock market bubble can go 2, 3 times bigger.
Yeah.
When it crashes, the ratio doesn't fall 10 times, it falls from 40 down to 1.
Yeah.
The ratio falls 40 times. In other words, with the paper money, things can go way crazier
Yeah.
on the way up, and when they crash a lot more horribly
Yeah.
on the way down. And again, from 1, the ratio goes up to 50, which
Yeah.
means that the stock market outperformed 50 times. But when they crash, you could easily expect that gold would outperform stocks 50 or so times. Yeah, it could be 40, it could be 30. Right now, we see that the ratio from 50 to 20 or 17, gold has outperformed stocks about roughly 3 times. But there is a lot more to outperform from here. The ratio is still 17 at the moment.
But if you say the green line is the long-term trend,
Correct.
why is the middle of the long-term trend not 21? The middle of the green line today is 21.
Correct.
And you said today we are 17.
17,
That's lower.
Correct.
If
But usually-
21 is the
Correct.
long-term average, I don't understand why you then say that we can.
Look, that's what I was explaining.
Okay.
It never goes at the average. It doesn't follow
I
the
understand
average.
that, but
In
the average
nature,
is what it swings about.
humans swing from total craziness about investing in real estate, where they drive prices sky high, like they did in Japan or here or anywhere else, and then they crash big time, like they did in Greece. I mean, you go in Greece now, you can buy a nice little house closer at the beach for what? 25,000 euro. Okay, dirt cheap. They've fallen 5 times so far. In Athens, you can go and buy a tiny, nice, compact apartment, 30, 40 square meters, 35, 40 square meters, for the phenomenal 10,000 euro. That's what, 60 or 70? 70. And that's like cheap. It's like almost free. You see, so they would swing in Greece 5 times. For the moment, have fallen. In other words, people can go crazy on the one side, but it can crash on the other side just as badly or worse. Yes, somebody question?
There's over there.
Yes?
Yeah.
Yes?
But 1913, if you had 100 unit, 100 unit, 100 you invested in Dow index, 100 you invested in gold.
When?
In 1913.
Yes.
Where would you be then in 1980 with the 100 in gold and the 100 in Dow?
Well, we'll have to,
180.
we have to calculate it. You'd be, for the most part, just about the same, not far. Well, no, in 1980, when
I
gold is
started-
up,